So in this video, we're going to look at the income statement approach for estimating credit losses. This is different from the balance sheet approach. So with this approach, management will still use past experience, but instead of aging the accounts receivable, management will use past experience and estimate the uncollectible accounts expense based on the percentage of net credit sales. So management will say, okay, what percent of net credit sales usually, on average, is proven to be uncollectible each period? And they will use that then to determine the amount of the adjusting entry needed when they record uncollectible accounts expense for the period and adjust the allowance for doubtful accounts account. That's one major difference on how they find the amount. The other major difference between this approach and the balance sheet approach is that under this approach, we don't care about the prior balance and allowance for doubtful accounts. Instead, once we find this percentage of net credit sales, we take that full amount, debit it to uncollectible accounts expense, and credit that full amount to allowance for doubtful accounts. And with the balance sheet approach, we care what the prior balance is in allowance for doubtful accounts because we based on that prior balance, we find the amount of the entry. But in this approach, we don't care what the prior balance was in allowance for doubtful accounts. We just take the full amount of the percentage of net credit sales that is deemed uncollectible and debit that full amount to uncollectible accounts expense and credit that full amount to allowance for doubtful accounts. So let's look at an example. It says, to illustrate, assume that a company's past experience indicates that about 2% of its credit sales were proved to be uncollectible. If credit sales for September amount to $150,000, the month-end adjusting entry to record uncollectible accounts expense is as follows. So here what we would do, we would take the credit sales here of $150,000 for the month, and they say based on past experience, any given month's credit sales, 2% of it is usually deemed uncollectible. So let's find 2% of $150,000. So we'll do $150,000 times 0.02. So this tells us that about $3,000 of that $150,000 will most likely be uncollectible. We won't ever see $3,000 of that $150,000. So under this method, how would we record that? Well, we will simply debit the account uncollectible accounts expense for that full amount of $3,000, and we will credit the allowance for doubtful accounts account for $3,000. So what's the main difference here? Well, the structure of the entry is the same when compared to the other approach, but the amount of the estimate, the $3,000, we debit that full amount and credit that full amount to these accounts here. We do not care what the prior balance is in allowance for doubtful accounts from the prior period. This $3,000 just gets added into whatever the previous balance was in allowance for doubtful accounts. Okay, so that's the income statement approach and how it differs from the balance sheet approach. Now, one other thing we have to look at is, sometimes a company will write off an accounts receivable. Let's say, this customer Bob hasn't paid us for 3 months. It's past due. We're probably never going to collect that accounts receivable from Bob. So a company will just write it off. They will debit allowance for doubtful accounts and they will credit the accounts receivable. But then what happens when Bob actually ends up paying? We have to look at what would the accounting look like when that happens. So again, sometimes we write off accounts receivable that's actually collected at a later date. So in this case, let's assume that a company wrote off a $500 accounts receivable from Brad Wilson on February 16th. They thought Brad was never going to pay. So initially, when they wrote off that $500 accounts receivable from Brad Wilson, they made the following entry. They used some of their allowance and allowance for doubtful accounts balance, so they debited the allowance account for $500, and they credited accounts receivable, Brad Wilson's accounts receivable, for $500. But when Brad actually finally pays, what would that write-off look like? Well, we would have to reverse the write-off first. So first, we would have to just completely reverse what happened here. So we would have to debit accounts receivable for $500, put it back, so to speak, and we would credit allowance for doubtful accounts to put that amount back that we took out. So we debit accounts receivable for $500, credit the allowance for doubtful accounts for $500 to reverse the entry above. Okay, and then since Brad actually paid, once you actually reverse that entry from above and Brad actually paid, then you would actually finally debit cash for $500 and then once again credit accounts receivable for $500. But the important thing is you can't do this before you reverse the entry up above, because you can't credit accounts receivable twice for the same account, right? So the first thing is if you wrote off an account up above, but then, oops, the customer actually paid you, first reverse the entry, and then you can debit cash and finally remove that accounts receivable for good. All right, so that was the income statement method and also what it looks like to reverse a previously written off account that was actually collected. Keep watching to see how to apply the direct write-off method, which is a lot different from the income statement method and the balance sheet method. And we'll also look briefly at factoring of accounts receivable and the advantage of credit card sales.